Introduction to Microfinance, Beginner's Course. Introduction. To fully understand how the microfinance institution works, it is important to fully understand the history of microfinance and what it was meant to achieve. Our current microfinance practice is in no way different from what commercial banks do. They both grant loans and accept deposits where necessary, except for some exceptions that distinguish them from large banking structures. Financial services are no longer for the active poor alone, but for all. The main goal of microfinancing is to provide resourceful finances so that people who need financial resources can have access so they can run their businesses profitably. Starting or working in a microfinance institution is not enough for anyone to tag an earning point. It must be born by desire. It must be motivated by a desire to learn about what happened in the past and how people helped and solve each other's financial problems. Let's listen to the story I titled, Small Money and Big Change. Every morning, traders arrange their goods, artisans sharpen their tools, and food vendors light their stoves. Money flows here in small amounts, but it flows every single day. This is where microfinance belongs. In this market lived a woman named Mama Tommy. Mama Tommy sold fried bean cakes by the roadside. She was hardworking, consistent, and trusted by her customers. Yet her business never seemed to grow beyond survival. Not because she lacked customers, but because she lacked capital. When Mama Tommy approached a commercial bank for a loan, they asked for land documents, guarantors with salary accounts, and years of financial records. She had none of these. So, like millions of others, she was invisible to the formal financial system. Then something different happened. A microfinance bank opened a small branch near the market. Not a fancy building, just a place where traders felt welcome. Instead of asking Mama Tommy what assets she owned, the loan officer asked her simple questions. How long have you been selling? How much do you make on a good day? What do you want to grow? For the first time, someone understood her business. Mama Tommy was introduced to something called group lending. She joined 4 other women, each running a small business. Together, they formed a group not just to borrow money, but to support one another. No land titles, no expensive collateral. Their guarantee was trust and accountability. The bank explained the rules clearly. Loans would be small but useful. Repayments would be weekly and affordable. Meetings would be regular. Training would be provided. Savings would be encouraged. This wasn't charity. This was structured finance, designed for their reality. Each woman received a loan. Mama Tommy's loan was modest, but powerful. With it, she bought a bigger frying pan and more ingredients and built a small wooden kiosk. Almost immediately, her output doubled. Customers who used to wait now came earlier. Some even placed orders in advance. The money didn't sleep in her pocket. It went straight to work. Every week, the group met. They repaid their loans in small portions, aligned with their daily cash flow. The bank didn't just collect money, it listened. Officers monitored businesses, offered advice, and taught simple financial skills, how to price goods, how to save, and how to plan for slow seasons. The repayments from Mama Tommy and her group didn't disappear. They were relent to other traders. That is the engine of microfinance. Borrow, grow, repay, and pass opportunity forward. As months passed, something bigger happened. Mama Tommy hired help. The tailor next door bought another sewing machine. The fruit seller started supplying offices. The shoemaker moved from the street into a shop. Suppliers sold more. Transporters worked more. Jobs were created. Without realizing it, microfinance had stimulated the entire local economy. Then came the rainy season. Sales dropped. Cash flow tightened. But the microfinance bank didn't panic. Instead of punishment, there was adjustment. Loan terms were reviewed. Grace periods were introduced. Savings were used as buffers. This flexibility, this understanding of real-life business cycles, is why microfinance survives where rigid systems fail. 1 year later, Mama Tommy was no longer invisible. She had a savings account, a repayment history, business records, confidence. She was now bankable. The same commercial bank that once rejected her began offering her new products, not out of sympathy, but because microfinance had proven her creditworthiness. And this is where the story becomes clear. Microfinance works because it is built around cash flow, not collateral. It is rooted in community, not isolation. It is supported by education, not just money. It is designed for sustainability, not handouts, and above all, it turns small money into economic movement. Know this. When we talk about microfinance, we are not talking about poverty eradication only. We're talking about building potential, about people who don't need pity but can transform trials to opportunity using small loans to build strong systems in real markets and other to create a lasting impact in any economy. That is how microfinance works in the real world. As we progress, do remember to subscribe to our channel at Microfinance Arena for more engaging learning content. Microfinance is a financial system designed to provide small loans, savings, and financial services to low-income individuals and small businesses who lack access to traditional banking. This has gone beyond serving just the active poor as initially introduced by scholars of microfinance theories. Microfinance has entered the era where every entrepreneur who is financially active becomes engaged and seeks access to funds that would ultimately promote his or her business. We're trying to explain to you how microfinance works, its structure, and its impact on the economy and the possible pitfalls that may cause loss to both the financial institution and its customers. But before moving further into understanding into how microfinance works, it is good we understand what a microfinance bank is so we merge how they relate and function. A microfinance bank is an organization that provides various financial services to low-income clients, including saving, insurance, leasing, loan granting, and other financial services that help their client situations. As you can see from both definitions, the former is a system while the latter is a process. History of microfinancing. Microfinance was not widely practiced until Professor Muhammad Yunus made it a global phenomenon. People and organizations began to recognize and capitalize on the opportunities inherent in the microfinance sector. Microfinance was once used for humanitarian purposes, but it is now primarily for profit maximization. Developing countries are unlikely to make significant progress unless they embrace microfinance, which is why regulatory authorities in various countries are introducing policies to develop the microfinance industry. The system will continue to require refinement because so much needs to be accomplished to address the day-to-day problems associated with owning and operating a microfinance institution. Microfinance originated in developing countries in the 1960s, while refinement began in the United States, Bangladesh, and parts of Latin America from the mid-1970s to the 1980s. The need to support growing economies prompted development organizations to contribute to the growth of microfinance institutions. Among these organizations are the World Bank Group, the International Fund for Agricultural Development, and various United Nations agencies. Grameen Bank, Action International, and ASE were among the early active players in providing microenterprise activities. However, there has been good documentation of participation by other microfinance institutions from all over the world. Microfinance has now become a global movement spearheaded by governments from various countries, corporate and multinational corporations, private business entities, and individuals, with statistics indicating that its adoption rate is constantly increasing due to the success record of its impact on the poor. We know that informal microfinance groups have existed in developing countries for centuries. The fact that microfinance began in the early 1960s does not mean it was never in existence. The significance of the period is when it began to have roots in people's operations, though it had been in existence since the 1800s when village banking was popular in Germany. According to the Consultative Group to Assist the Poor (CGP) report, close to 500 million people have benefited from small loans in one way or another, and all of these people had access to these funds from close to 10,000 microfinance institutions located all over the world. Entry of the Microfinance Bank. A viable microfinance bank would enter the market with offerings such as small loans, no traditional collateral, lending model, repayment structure, a business and financial training. Trust me, this is the real economy. Small businesses power big communities. Yet, for many, access to finance remains out of reach. Microfinance begins with small loans, designed for real businesses, not boardrooms. These loans help traders buy inventory, improve tools, and increase production, which are usually small amounts but end up making a big impact. Unlike traditional banks, microfinance removes the barrier of collateral. No land titles, no expensive assets. Instead, it looks at commitment, cash flow, and business potential. Trust becomes collateral. Peer accountability reduces risk. When one person grows, the entire economy grows. Repayments are structured, small, manageable, and aligned with daily cash flow. This builds discipline, consistency, and a strong repayment culture. Microfinance goes beyond money alone. Clients receive business and financial training, learning how to manage cash, price products, save, and plan for growth. With small loans, no collateral barriers, group support, structured repayment, and training, microfinance transforms markets. It builds businesses and creates jobs that strengthens. Reasons for microfinance. The main aim of microfinancing is to adequately promote the granting of financial services to low-income earners and create an avenue where credit and other financial services are available at a reasonable cost with solutions tailored towards the needs and demography of the poor. Microfinance will give meaning and purpose if it is made visible for public awareness and impacts sustainable access to a wide range of financial services that support strategies that encourage partnerships and innovations needed to build and expand appropriate outreach. Microfinance loans are administered by these institutions, namely state governments, commercial banks, microfinance institutions and banks, MFIs and MFBs, non-government organizations, NGOs, informal money lenders and groups, pawn shops in some countries, transfer payment and communication companies, non-bank financial institutions, NBFI, credit union, CU, and mobile network operators, MNOs. How microfinance operates. No financial institution works in isolation. They operate in conjunction with systems, procedures, and appropriate manpower, and the most important factor that makes it function is determined by the factor played by demand and supply, striking the balance needed to make the system work well. In microfinance activities, the demand for funds is pioneered by actions of borrowers or investors who need immediate funds for the execution of their business enterprise. These funds are provided by individuals or private or corporate entities, also known as savers or investors, who have no immediate use for such funds and as such keep these funds with the MFBs, who in turn lend them out to deserving clients. These savers operate in the surplus unit by coming out to help investors who operate in the deficit unit. And with the intervention of MFIs, financial intermediation is made possible. You can imagine what the financial system would look like without the presence of financial intermediaries, as there would be disequilibrium between the demand and supply of funds. Even when the surplus and deficit units meet without intermediary intervention, there are bound to be trust and confidentiality problems with high exposure placed on the surplus unit, leaving the deficit unit with nothing to lose. Wise fund providers usually invest in projects or proposals with minimal risk even when the interest is high, and this is why they prefer to keep these spare funds with the financial institutions, who in turn give them out as loans to investors, not minding the interest rate. Without suppliers of capital, i.e., savers, investors in turn are left to their resources, in other words, self-finance. The difficulty here is that not every prospective investor has the funds required at his disposal. Investment opportunities are thus restricted by the investor's capital resources. As a result, investments are only embarked on over a certain period when needed funds have been amassed for the proposed project. Due to insufficient information and confidence problems, direct financial relationships between savers and investors are only found within social groups, e.g., in village communities or among families and friends. Direct financial relationships afford definite advantages for both parties. A prospective investor can make investments that exceed his resources, allowing the accrual of capital to occur with greater flexibility and efficiency. And for the savers, it is more convenient to entrust their savings temporarily to an investor than to look for investment opportunities alone. Even if information and confidence problems are mitigated, there are structural obstacles to direct financial relationships stemming from differing preferences of savers and investors regarding the mode of finance. A financial relationship, therefore, presupposes a broad agreement on the amount, term, risk, and expected return between the borrower and the lender. Benefits of microfinance. According to the Global Finance Development Report of 2014, more than 2.5 billion adults have no access to any form of bank account. It is quite alarming that the number of unbanked adults has recently skyrocketed beyond recognition. The true picture is that the financial system has systematically excluded them from having access to finance, which they rightly deserve. Microfinance activities provide a key strategy that helps active players who live in poverty become financially independent. Below, we highlight the benefits of microfinance. It is a key strategy to empower individuals economically and financially. It promotes a high level of sustainable growth for micro, small, and medium enterprises, MSMEs. Microfinance institutions not only give loans, but also help monitor and coach micro clients on how to manage their business. And this is because direct interaction exists between the MFB and the customer. Commercial banks grant loans to clients based on the availability of assets as collateral, while for an MFI, a client with no form of collateral can easily have access to a loan if he can provide the institution with a favorable cash flow over the period he intends to pay back the loan. It offers opportunities for job creation and entrepreneurship, and at the same time empowers literacy education, as children are unlikely to be withdrawn from school due to the non-availability of funds to pay for school fees. It provides for families at the appropriate time and makes them feel they are part of a functional financial ecosystem. It offers flexible repayment plans, which are not usually obtained from commercial banks and traditional or non-formal financial institutions. It encourages and promotes present and future investment by making funds available for business endeavors, thereby sustaining productivity. The process is sustainable, hence the increase in MFIs all over the world with the availability of small amounts of loans to solve rising business issues. Apart from loans, it gives micro-entrepreneurs the avenue to save their little monies on a daily to monthly basis, because the main concept of microfinance is not to wait for the poor clients to come to the bank, but for the bank to go to the customers. When an economy prospers, the citizen also prospers. In this vein, microfinance activity offers viable economic gains to the citizenry as it increases the spending and consumption level. It reduces vulnerability encountered by poor people who have the acumen and good business plan needed to break through, but don't have the finances to carry out the proposed projects. It gradually reduces economic poverty for every participant with the view that participating in microfinance activities has been able to show significant development over some time. Problems of microfinance. In many developing microfinance markets, we have challenges that culminates to. Small traders dominate the economy. Most businesses operate with daily cash flow. The traditional banks requiring collateral. This and much more is making a lot of hardworking people are financially excluded because they're not fully literate enough to have access to funds to boost their business. Another important challenge to look at is the issue of mission drift. Microfinance institutions tend to focus more on profit generation only rather than concentrating on and actualizing both profit and social goals, which brings up the question if truly MFBs are helping people or are just concerned about themselves. In some countries, microfinance activities are so well regulated that it becomes difficult for them to introduce or impose obnoxious policies. In the same vein, customers take priority for repayment because refusal to repay is seen as a grave offense. While this practice seems okay, this is not usually the case in countries where government control in the microfinance sector is very minimal. The good thing about modern-day microfinancing is that the industry is recording a phenomenal increase in innovation with the advent of inclusive digital banking. The use of electronic banking, mobile banking, and every accessible order means is what the sector needs to continually grow. The microfinance industry has long depended on paper-based methods of transaction, which some still practice up to date due to the high increase of illiteracy found mostly in African countries, while some have evolved along with technological advancement and digital microfinance. The paper-based method is usually associated with credit officers making numerous unhelpful trips to obtain customer details for loan processing, which is usually time-consuming. The digital microfinance application process is always at the tip of a button, allowing for swift credit decisions and transactions. While it is a fact that a microfinance loan increases the chances of income accumulation through access to finance, it can also create high indebtedness that may likely increase the chances of poverty for a client over time. This situation arises when a client has access to funds way above or below what he needs to run his business. Conclusion. In conclusion, it is important to state that microfinance is not charity. It is a structured financial system that unlocks hidden potential, supports entrepreneurship, drives inclusive economic growth, all to the benefit of business success, personal growth, and economic development. Stay tuned for more from the Microfinance Arena channel as Leon Consulting brings more exciting learning experiences. Kindly do well to subscribe to receive more notifications when we release new learning videos. For now, bye.